Consolidation, the financial statements of a parent and all the subsidiaries are combined into one set of financial statements. It's important to remember that each of the subsidiaries produces their own set of financial statements, and a consolidation is essentially a what-if analysis of looking at all the data when it's combined. And one thing that has to happen when you do a consolidation is to post elimination entries to remove intercompany transactions, which are transactions between the parent and the subsidiary. So the only thing that remains is transactions with third-party entities. So that's what an elimination entry is. Now you can have both an upstream and a downstream transaction, so let's explain what that means. So let's assume that a subsidiary sells something to a parent. That would be an upstream transaction. Let's say that subsidiary sells inventory with a cost of $8,000 to a parent at a retail price of $10,000. The $2,000 profit needs to be removed from the subsidiary's books. And the other side of the coin is that the inventory on the parent's books is too high by $2,000, so we need to reduce inventory by $2,000. So net income declines, inventory declines in the consolidation so that the financial impact of that transaction is removed. The same thing can happen if it's downstream, where a parent sells inventory to a subsidiary. It's a downstream transaction, but the same rules apply. The profit on the sale needs to be removed from the seller. The buyer needs to reduce the value of the inventory by the amount of the profit, so it's not reflected in the consolidated financial statements. The other thing I wanted to talk about is goodwill. How is goodwill created? Goodwill occurs when a company buys another company and pays more than the fair market value of assets and liabilities. So let's say that Acme Lumber is going to buy Standard Lumber. They pay $1.2 million. But the fair market value of Standard Lumber, the seller's assets and liabilities, is only $1 million. So they have paid more than the fair market value by $200,000. On the buyer's books, Acme's books, we would post goodwill of $200,000 to reflect the fact that they paid $200,000 more than the fair market value of the assets and liabilities of the seller. So that is how goodwill is created.